Welcome to Iron Financial. We're the place you come to forge a stronger portfolio because we stress test the market's biggest names. We don't follow the hype, we follow the numbers, and we look for the cracks. And today, we are putting a true market darling right under the microscope, Supermicro. This is a company that has absolutely ridden the AI wave to some incredible, dizzying heights. But we're here to do what we always do, see if the foundations are as strong as the hype.
So, let's start with the headline that's got everyone's attention. Supermicro just raised its full-year revenue forecast to a staggering $40 billion. Let me repeat that, $40 billion. Now, the market sees a titan of industry being forged in the white-hot fires of the AI revolution. But here at Iron Financial, we always check the quality of the steel. We want to know, is this a company that's built to stand the test of time, or is this just a house of cards waiting for the first strong wind to knock it over?
You know, 40 billion is a heavy number. It's meant to impress. But explosive growth, the kind that happens this fast, can hide some really deep cracks. When you see a skyscraper go up practically overnight, you have to start asking some serious questions about the foundation. Are we looking at a solid steel frame that's been designed for the long haul, or is this just hype and sheet metal bolted together in a hurry? I'm here to ask those tough questions and make sure we're not all just getting caught up in the excitement. So let's drill down and see if this structure can actually handle the weight it's claiming to hold. Okay, let's get into it. We're going to break this down methodically, piece by piece. First, we have to look at the AI revenue explosion, that incredible growth story that has the bulls so excited. Then, we're going to examine the price of that speed, looking at the squeezing margins that are raising some major red flags for us. From there, we're going to crack open the SEC filings and see what the company is really telling investors about the risks hidden in the fine print. And finally, we'll lay out our verdict. Is this a fortress or a house of cards?
All right, let's give the bulls their due. We have to start with their case. And I'll admit, the numbers are impressive. They are almost impossible to ignore. But I really want to know where they're coming from. How does a company like Supermicro suddenly get to a $40 billion forecast? You can't just pull a number that big out of thin air. So show us the launch pad. Where is this rocket ship getting all of its fuel?
Just look at this trajectory. This right here is what a financial explosion looks like on a balance sheet. In fiscal year 2023, they posted $7.1 billion in net sales. Solid, respectable number for a hardware company. But then, the very next year, fiscal 2024, that number more than doubles to $15 billion. And just when you think that kind of growth has to cool off, it jumps another massive 47% in fiscal 2025 to $22 billion. This isn't just growth. This is pure, unadulterated AI-fueled acceleration. They are strapping themselves to the biggest technological shift of our generation, and it is paying off massively on the top line.
So they are the ones literally building the backbone of AI. You could call them the picks and shovels play in this digital gold rush. They aren't selling some abstract concept of AI. They are selling the heavy iron, the dense servers that make it all run. And the demand for that hardware is just undeniable. But those growth numbers, they're almost hard to believe. They just feel unsustainable. What is driving this most recent surge? Is this some one-time event, or are we looking at the new normal? What happened to make them revise their guidance so dramatically upward?
This number is the answer, $12.7 billion. That's their net sales for a single quarter, the one ending December 31st, 2025. Now let me put that number into perspective for you, because it's crucial. They didn't just meet Wall Street's expectations, they completely shattered them, beating estimates by over $2 billion. And get this, that single quarter's revenue is more than their entire sales for all of fiscal year 2023 combined. Think about that. They basically did a full year's work in just 3 months. This isn't just riding a wave anymore. They are becoming the wave. Okay, the top line growth is absolutely monumental. No one can argue with that. It's a rocket ship, plain and simple. We've established that. But here's the thing about rockets. They burn an incredible amount of fuel and they operate under extreme stress. This kind of growth never, ever comes for free. So the real question is, what is this growth costing them? Are they sacrificing profitability just to post these huge revenue numbers? It's time to look at the margins.
That is exactly the right question to be asking. The top line, that's the sizzle. The margins, that's the stake. A company isn't what it sells, it's what it keeps. So let's move out of the flashy showroom and down into the engine room and see how efficiently this machine is actually running. Because when we look under the hood, the numbers show significant, absolutely undeniable strain. And this is where the bull case really starts to wobble, and it wobbles badly. Now, what's really telling and frankly alarming about this slide is the inverse relationship you see here. This chart is the entire bear thesis in 4 simple lines. As their sales have absolutely exploded upwards, their gross margins have collapsed downwards. They went from a very respectable 18% in fiscal 2023, which is quite healthy for a hardware business, down to 13.8%. Okay, that's a significant drop, but maybe you could argue it's manageable. But then it gets serious. It's a stomach-churning drop to 9.5%. And now, in the latest quarter where they posted that record revenue, they're down to just 6.3%. That is a massive red flag.
That is a huge drop. Let's make that real for a second. For every $100 of hardware they sell, they went from making $18 in gross profit to now just a little over $6. They are literally working 3 times as hard just to make 1/3 of the profit on each unit they ship out the door. That feels like a race to the bottom, not a path to dominance. So why is this happening? Is this some conscious strategy, or is it a glaring sign of weakness? This isn't some startup burning cash to acquire users. This is a multi-billion-dollar company. Why are their margins getting absolutely crushed?
While the company tells us directly in their SEC filings, this isn't a secret they're trying to hide. They're openly stating that they are intentionally cutting prices to win these large-scale customers and grab as much market share as they can in this AI gold rush. They're prioritizing a land grab over profitability. This is a classic volume over margin strategy. They're making a bet, a huge bet, that they can make up for these paper-thin margins with sheer overwhelming scale. It is a high-stakes gamble, and it's one that could either pay off magnificently or end in total disaster.
Okay, so aggressive pricing is one thing. You can argue it's a strategic choice, even if it is a risky one. But that doesn't explain all the potential risks. That's business strategy. What about the foundation of the business itself? Let's move past the strategy and get into the structure. What else did you find when you cracked open the filings? I want to know what the company is telling regulators and serious investors about the risks, not just the rewards. What aren't they putting in the glossy press releases and the shareholder presentations? This is where the real stress test begins.
Exactly. When you dig into the 10K, that legal boilerplate that most people just skip over, that's where you find the real structural risks, and it is all there in black and white. First, they warn that their customer base is becoming more concentrated. In plain English, that means they are increasingly dependent on a few huge customers. If you lose one of those whales, there is a massive hole in your revenue. Second, there's a history of failing to file SEC reports on time, which points to internal chaos and disorganization. And third, and this is something an investor never wants to see, multiple class action lawsuits filed against the company and its top executives. These are serious red flags, and they suggest that there may be some very deep-seated problems at this company. Whoa, wait a minute, back up. An adverse opinion? That sounds really serious. That's not a phrase you just skim over in a report. In plain English, what does that mean for an investor? Are we being told that the company's financials aren't even reliable? This sounds like more than just some procedural issue. This sounds like a fundamental problem with how they count their own money. What is the auditor telling us here? It's a massive, massive red flag. This is the auditor's equivalent of pulling the fire alarm in a crowded theater. It is the most severe finding an auditor can possibly issue. It means they looked at the company's internal processes for creating their financial numbers, the very numbers we've been looking at, and they concluded that they have no confidence that those processes are effective at preventing or detecting major errors. This is often directly linked to those class action lawsuits we mentioned, which allege misrepresentations in their financial statements. The auditors are essentially saying the control systems are broken. This is a huge problem, and it's one that every potential investor needs to be deeply aware of. So on one hand, you have this absolute rocket ship of revenue growth. But on the other hand, the auditors are screaming that the control panels are faulty and sparking. That is a terrifying combination for any portfolio. So how does management reconcile these two completely opposite realities? What is their story? Are they even addressing these very serious concerns, or are they just ignoring them and hoping the giant growth numbers distract everyone? How are they calming the market when their own auditors are raising the loudest possible alarms? Well, the CEO is focused squarely on growth. His message is simple. Don't look at the past, look at the future. He's betting that their new modular data center solutions, what they call building block solutions, will allow them to land even more of these massive customers. He's promising to double their key accounts in a single year, from 4 to as many as 8. He is telling the market to ignore the noise and focus on the explosive demand. But is that enough? Can a company really grow its way out of fundamental control problems? Or will the problems just grow right along with it? And they are backing up that story with hard numbers. It's not just talk. The forecast for the very next quarter is another massive print, at least $12.3 billion. They are essentially signaling that the Q2 performance wasn't some fluke.
They are telling investors that this new, elevated level of revenue is the new normal, and that there's absolutely no slowdown in demand on the horizon. They're not just fanning the flames, they're pouring gasoline on the fire. And this is a high-wire act. It's the ultimate conflict for an investor. They're telling the market to look ahead at the incredible view from the top of the skyscraper, while hoping that nobody looks down at the fraying rope they are walking on. The promise of the future is spectacular, but the evidence from the present and the recent past is deeply, deeply concerning. It forces you to decide what you trust more, the CEO's exciting forecast or his own auditor's dire warning. And that is a decision that could make or break your entire portfolio.
So we've laid out the bull case and the bear case. We've seen the rocket fuel and we've seen the faulty wiring. Now it's time for the verdict. This is what we do at Iron Financial. We take all the emotion out of it and we look at the structure. So let's put the bull and bear cases side by side to get a clear, unbiased picture of the structure that we're analyzing here. Is it a fortress being built for the ages, or is it a house of cards just waiting for a gust of wind?
And this slide really lays it bare. It looks like two completely different companies on one slide. The bulls see an unstoppable force, a fortress being built on the very bedrock of the AI revolution. They see aggressive market share gains and a CEO with a clear vision for total domination. The bears, on the other hand, see a company that's growing way too fast to control its own foundations, a company that is sacrificing profitability and, more importantly, financial integrity for growth at all costs. They see cracks that could bring the whole thing down. So which one is it?
The company has, without a doubt, built an incredible engine of growth. They have made themselves indispensable to the AI revolution in a remarkably short period of time, and the market is rewarding them for it, sending the stock to incredible, stratospheric heights. But the risks, which are documented in their own SEC filings and confirmed by their own auditors, simply cannot be ignored. These aren't opinions, these are documented facts from the company and its independent overseers. And they are facts that you absolutely need to consider before you invest a single dollar in this company.
And that's the billion-dollar question, isn't it? Is this a generational buying opportunity to get in on the ground floor of a new industry titan? Or is it a trap, a value illusion built on weak controls and unsustainable growth? Here at Iron Financial, we give you the data. We stress test the structure. The final build is always yours. But we will leave you with this final thought. Are you willing to bet your hard-earned money on a company that's growing at a breakneck pace, but has an auditor that's sounding the loudest alarm bell they possibly can? That's a question only you can answer.